Last time I talked about the need to buy companies that have a high return on assets, that are inexpensively priced, have little or no debt, and so on. That video was called Stock Investing 101. If you haven't watched it, I suggest you do so, because today we're going to be talking about how to access those companies as safely as possible. And it's pointless talking about how to access them using options in this case if we don't know the types of companies we're looking for. So go on back and watch that video if you haven't done so already. Go on. Go back. Okay, so as I mentioned in the last piece, central bankers, in their vain attempt to fix things and to make things better, have driven interest rates to the point where savers are getting punished. Can save capital are being forced to reach into riskier and riskier assets to seek yield, and that's driving up the value of asset markets around the world, and that's making it a very, very dangerous time to invest. This is the backdrop in which we have to invest. That's what I want to talk about today, how to do it most effectively and most safely using call options on these different companies. You can find bargains, you can find good investments in any market. If we're going to access these gems in this otherwise overly expensive market, we need to know how call options work. A call option is a type of investment that gives the owner of the option, the owner of the call in this case, the right but imposes no obligation to purchase a certain asset, in this case a stock, at a certain price for a certain predetermined period of time. That's it. So once they buy the call, there are no further obligations imposed upon them. They now have all the rights to either exercise this option if the stock goes up in price, or let the option expire worthless, or sell the option between now and expiration date. Why would someone buy a call option? Well, they would buy a call option rather than buying the underlying shares, because the call option can be purchased for a fraction of the price of the actual shares themselves. It's a less risky way because you're putting up less money than if you actually just bought the underlying shares and forgot about it. The best way to understand this is by way of example. There are a few wonderful businesses that I've uncovered, and I'll talk about one of them. It's currently trading for about $63 a share, a fantastic return on assets, little or no debt, although it uses its accounts payables to fund its net working capital. Fancy way to say that they use their suppliers to fund their business, which is really great. Have a 3% dividend. It's a wonderful, wonderful business. I believe that when the market comes down, not if, but when the market comes down, even wonderful businesses like this are going to suffer. I believe that taking on the risk of buying it at $63 a share or $6,300 for 100 shares is actually a bit of a spicy meatball. I think it's a bit risky at the moment. So my alternative is I can buy a call option, which gives me the right to buy it at $63 a share for the next 9 months. And for that right, I'll pay $420. I believe it's less risky, mathematically less risky, to put up $420 than it is to put up $6,300. And because I have less risk putting up $420 than $6,300, I have some advantages. I can take what I didn't spend on the shares and buy a bond with that, or a safe GIC if you're in Canada, or a CD if you're in the United States. Participate mostly in the upside of the company if the shares do really, really well, or the market continues to remain and becomes even more bloated. I can participate in that upside. And if the shares drop in price, I'm only out $420 for 100 shares, as opposed to a giant question mark of what I might be out if I paid $6,300 for these shares. Now, I've heard many criticisms of call options over the years. If you have any other criticisms, please leave them in the comments and I'll deal with those as well. The first and most common criticism is rooted in ignorance about how these things work. People have said to me, well, won't I be on the hook? Won't I have to buy the shares at $6,300 or $63 a share? There are certain other types of options that I'm not going to talk about today that impose an obligation on you. With a call option, the one I'm talking about today, like I said at the beginning, there's no further obligation imposed on you. In the example I've used, you have the right to buy this company at $63 a share until the option expires. Either exercise that option and buy those shares at that price, or you can sell the option itself that you paid $420 for. You could sell it for a much higher price if the shares rise in price, or you can wait for the thing to expire worthless. There's no further obligation imposed on you. Criticism number 2 is that I'm going to miss out on the dividends. What happens when a dividend gets paid is that the value of the company, the shares, actually drop. That's the theory. In theory, then, because the shares drop, you're purchasing the call at a cheaper price. The call can anticipate these future dividends, and so therefore you don't have to pay as much upfront for the call. So in the example of the company that I'm looking at that's trading for $63, if it didn't have a 3% dividend attached to it, instead of only paying $420 for the call, I might have to pay $520 or $620 or a higher price. In a sense, it's a yes and no. I do miss out on the dividends, but I get to participate in the company at a much cheaper price because the value of the call is dropped. Another criticism that's quite common is that people are uncomfortable with the lifespan. To that criticism, I'd say a few things. First, I think lifespans or drop dead dates actually might benefit investors because there's so many people, tens of thousands of investors who have investments on their books that haven't panned out, that they bought maybe 3, 5, 10 years ago, that they believe is just going to, sooner or later, it's coming back. It's not going to come back. And in the meantime, this capital is being wasted. They could do better things with it. A drop dead date or an expiration date actually might be good for investors. Short-term painful, just like exercise, but in the long term, it might actually be good for them, just like exercise. The second thing I'd say about expirations is that it's true. Call options obviously do expire. They, in a sense, allow us to reset the universe, and that's actually, in my opinion, an advantage. So again, we have a company that's trading at $63 a share. I can access that price anytime for the next 9 months for $420, so $4.20 a share. Now, in this overvalued market, let's say that between now and 9 months from now, the market drops and these wonderful shares go from $63 to $53, just to pick a number at random. The owner of the shares suffers a $1,000 paper loss in that case, and my shares, or my options rather, that allow me to buy the company at $63 would be worthless because who wants to buy something at $63? We can just go to the market and buy it at $53. The options will expire worthless in 9 months' time. Fine. In 9 months, the shareholder has suffered a $1,000 paper loss. I can go back to the market, put up another $420 to buy the right to buy these shares then at $53 a share. And I can keep doing that for just shy of 11 years before I've put up the same amount of money that the shareholder put up on day one. I can participate in the up and down movements of the stock by every 9 months resetting myself and buying a right to buy at that price. So if the market does come down, my options that I spent a little bit of money on are going to expire worthless, but after it's come down, I then have the right to buy at a much, much lower price, which is going to massively inflate my return when the market returns to normal, if it ever does. And if it doesn't, then I'm only out a small amount of money using this expiration date, again, to clip my downside and keep my upside relatively high, which is of the essence, of course, of good investing. Options are a very powerful way to participate in the upward movement of the stock. A great way to actually limit your downside as well. I've mentioned most of the criticisms I've heard. I think there's 3 main criticisms I've heard over the years. I'm sure you'll have some criticisms, and I look forward to seeing those in the comments. I'll close this piece on options by relating an anecdote that happened to me a couple of years ago. I actually went home and took notes on the conversation. December 2012, I was in the investing section of the chapters at Bay and Bloor, the Manulife Center. In Toronto, as I usually am around Christmas season. I got to talking to this fella who was, fascinated by RIM or BlackBerry. Once he found out what I did for a living, he was really, really keen to know what I thought of BlackBerry. And he seemed almost disappointed when I told him I didn't really know. I hadn't a clue what was going on with BlackBerry. I didn't know what was going to happen to their price, certainly. I wasn't forecasting it. I had no real opinion about it. I think he wanted some confirmation because he was quite excited and had convinced himself it was going back to $30 a share. At the time, I think it was trading around $14 to $15 a share. I sort of shrugged my shoulders and said, yeah, fantastic. It may not. I don't know. I got to talking to him, though, because I was thinking about options, as I frequently do, and said, well, why don't you do the following? Just so you know that I'm not trying to drum up business for myself, open this at a discount brokerage account or discount brokerage house if you don't have the ability to do options now. rather than spending $1,500 on shares of BlackBerry, why don't you put up $150 for the right to buy it at $15 a share? So if you're right and it goes to $30, your $150 will be worth intrinsically about $1,600. It'll be a massive return on the upside if you're right. And if you're wrong, rather than risking $1,500 on BlackBerry, I mean, it's BlackBerry we're talking about, you'd only be risking $150. He said to me, well, I don't like to play those risky games. I'd rather just buy the shares. I said to him, well, you're mathematically less exposed by putting up only $150 than by putting up $1,500. It's less risky to put up a smaller amount to control these shares than a larger amount. Why would you do it? Especially something like BlackBerry that doesn't even have a dividend attached to it and has such huge question marks around it. He just sort of went off muttering to himself about wanting to buy the shares and that I should probably get away from him or whatever. It just strikes to the heart of how investors sometimes make mistakes and don't quite understand the nature of risk. One of the first rules you want to understand is that you want to limit your downside and keep your upside unlimited, or as unlimited as you're going to get in the stock market. You limit your downside by putting up as little money as possible. You do that using a call that has a fraction of the price of the actual underlying shares. That's a sort of a mathematical sort of truism as far as I'm concerned. I look forward to your feedback on the subject. I haven't talked about the relatively esoteric stuff of options. I haven't talked about the other types of options or the other ways to play options, different strategies. I haven't talked about the Greeks, the rate of decay and all that other stuff. We can get more esoteric if you want to. I'm happy to do it, but I'll only do it if you guys seem interested. So write in the comments below if you want me to talk about options in the future, or you want me to get more detailed or more in depth about them, because I think they're fascinating and I think they're a great and very safe way to invest if you know what you're doing. And we can talk about that if you want to. But if you don't want to and you just want to understand it in general terms, I hope this primer has helped, and I look forward to any comments.